Welcome back to Squawk on the Street. We are live from Beverly Hills. We're at the Milken Conference. Joining me now is Dan Simkowitz. He's the co-president of Morgan Stanley. Capital markets coming under your purview, M&A, IPOs. Let's start with the credit markets,
sure,
if we can. So what are you seeing right now? You know, obviously, only a few weeks ago, there was a lot of concern. But generally speaking, spreads seem to be behaving themselves.
Yeah, I think, David, first of all, thanks for having us here at Milken. The spreads have rebounded pretty dramatically in the last couple of weeks, but I think the big issue is the secular dynamics in the credit market, which is, financial repression is over, so rates are higher, maybe structurally. At the same time, there's bank regulation and bank shareholder pressure on banks, so there is capital moving, out of the bank system. Insurance companies are outsourcing some of their credit, all to asset managers. And so the depth of that market, the old endowment model had very little credit. So sovereign wealth funds, pension funds, endowments now have a bigger allocation of credit. And you're seeing that support the market. And so I think one of your guests yesterday talked about it. When the public market traded off in early April, They stepped in, traditionally sort of viewed as a private credit manager, and stepped in the market. And so you see a real secular shift. And to a degree, we don't really think the distinctions between public and private are really that real.
Why not?
Because credit is credit. And I think corporate credit in particular, but I think it extends into real estate credit. Some of it will trade. And what we're seeing is that shift out of the insurance sort of in-house management, out of the banking system to asset managers, and then they all partner with us.
Right.
So what we're seeing is they want to see assets in both investment grade as well as non-investment grade, traded, non-traded, but there is a big secular shift into the asset managers, and it means we and our issuers have a deeper market to access in the credit market.
Right. Well, you referenced, of course, Mark Rohn, who also said he thinks investment grade, fixed income, you're not going to see a differentiation in 18 months between private and public. You agree with that?
Well, I think what Mark has done, and some of his peers, and they're all here, is what they've done, especially with insurance capital, is they've taken it as pure buy and hold, relatively plain vanilla, and they've moved it into much more actively managed portfolios. And actively managed could be private or it could be public, but what they're able to do is bring better solutions, frankly, into the market around structure, around asset-backed, and other elements. A lot of what they're doing with investment grade is they're bringing secured elements that have been used in the high-yield market or the leveraged finance market into the investment grade market. Now, it's not going to be as large. A big cap company that doesn't have the same needs as, let's say, a data center situation,
right,
or maybe a asset
just
a company
still
on
hit the public markets with a.
They'll just keep going, but there is more sophistication going because the capital is moving to great credit managers.
Yeah.
And that's not just Apollo, that's Blackstone and Ares. Mike was just here.
He was.
As an example, it's at PIMCO, it's at BlackRock. It gives us a lot more partners to work with, more sophisticated, a little bit more velocity.
To advise your clients in terms of how to access these markets. So it's here to stay, no doubt about that. I mean, we've been talking about it for years now, Dan, but obviously even more so.
Yeah, it's interesting. The energy here this year at Milken, I think, is high, largely coming out of the credit managers. And what's great is it's reflective of the legacy of Mike, right? He started this, the move of credit out of, let's say, traditional systems. He did it with the high-yield bonds, and then it moved to leveraged loans. But now the distinctions are blurring, and just the credit market is growing pretty dramatically as it relates to how it gets deployed by asset managers.
You have a view on this other thing we discussed a lot yesterday, liquidity, and whether you can really create these ETFs in some sort of ubiquitous way that are going to be able to give the retail investor access to.
I think what these managers in partnership with us, again, we're the largest wealth manager in the world, which means we're the largest allocator to the asset management industry, but also the largest allocator to private markets. And what these movement and pools means is the innovation is increasing. So as you think about whether it's the democratization of private markets or even the deployment of credit, there's innovation happening. And so you see partnerships happening. Our clients, Blackstone, Vanguard, and Wellington, have done a partnership.
Right.
You see KKR and Capital Group, BlackRock, PIMCO are innovating, and then Mark has got the ETFs. I'm not sure which ones are going to succeed, but some of them are around bringing more of that credit market to the hybrid between public and private. What we see is we're helping these asset managers raise capital. We help them R&D around structure. We source the assets for them. We finance some of them. We structure them. And then some of them, to Mark's point yesterday, some of them are going to trade and some of them won't. But to a degree, when we go raise capital for our issuers, whether it's 100 investors or a half a dozen, the same underlier and to a degree the same process that we're engaging. And even in that half a dozen situation, some of that's going to trade on the back end going forward.